Hello everyone. In this video, we'll discuss about a step-by-step approach that can be deployed by investors for investing in equity markets, because investing is basically a process and wherein the investor has to keep in to account a lot of factors or the lot of variables or forces that act in the stock market and act accordingly. And investing has to be for the long term. It is not like, if investing is not something which is you can call it as a flash in the pan, because it has to be one has to consistently get good results over a period of time. So that is something which is called investing. So say for example, if I talk about stock of Berkshire Hathaway, that company was incorporated way back in, I think, 1964 or 1965, and since then for close to, like, I think 50-55 years, the stock of Berkshire Hathaway has given returns to the tune of 19 to 20%. Now that is something which is long term. So if you see a fund manager or a particular mutual fund that has given good returns for 1 year, 2 years, or 3 years, no, that doesn't prove that particular fund manager or that particular mutual fund has given, or it doesn't guarantee that you can you are going to get similar kind of results in future as well, because one has to look for a long term. So when I say long term, in at least 10 years is something that usually we define it as a long term. So investing is all about investing consistently for a period of for over a long period of time, so that you get good returns on your capital. So what I've done is I've tried to summarize this entire process of investing in equities in a one particular slide, and what I've done is I have given a very macro level view, because it is not possible for anyone to cover the entire process in one slide. So what I've done is I have basically tried to cover the broad topics of how to invest in equities. So usually the investing process starts with what to buy, followed by when to buy, which is again followed by how much to buy, and when to sell. So basically, this is how this entire process goes. And again, so within what to buy, there are two categories. What I've done is I've put it under two categories. Like, one should only buy companies which have moats around them, and one should only buy companies which have honest and capable competitive management. That particular company is being run by. So that is how the entire slides that this entire slide has been that this entire slide has been made. So to begin with, what to buy, again, as I mentioned, there are two pointers. The first one is one should only buy the companies which have moats, which have economic moats. So basically, this concept of moat is something, and I'm also going to make a separate video on what is a moat and what are the different categories of moat. But then this particular concept of moat was coined by Warren Buffett, and basically this entire thing is like, moat is something which prevents a company from its competitors getting into its territory and taking its share or taking its market share away from it. So basically, moat was something which were used during the medieval times, when the castles used to have moats around them with all these crocodiles and other animals, and then basically it used to safeguard the castle against the invaders coming in and getting control of it. So in to put it in a business, to put it from a business perspective, a moat is something which protects a company from its competitors, and who try to get its or who try to share snatch its market share. Because as we all know, capitalism is very brutal, and wherever the companies which are operating in industry where the operating profit margins or the profit margins are very high, then definitely the competition will arrive at the doorstep and try to take the market share of that particular leader, and so on and so forth. So it is very important that we as an investor should only invest in companies which have a moat around it, which has sustainable moat around it, not only today but then over down the line as well. So that is why Warren Buffett consistently asks for tells people that one should only invest in companies that have wide sustainable moats around them, because those are the companies that create tremendous wealth for its shareholders. So one of the techniques that you can deploy to identify which company has a moat is that you can look at its return on capital employed, which is also called as ROCE, and see if that particular company's ROCE is greater than cost of capital, or to put it to be specific, weighted average cost of capital. So wherever the return on capital employed is greater than weighted average cost of capital, you can definitely be assured that that particular, and that is over a period of time, not that for 1 year or 2 years or 3 years. So I'm saying that if a and companies consistently delivering growth in excess of WACC over a long period of time, let's say for the last 10 years, 15 years, 20 years. So you can be you can be at least assured that this company has something special. There is something special about this because of which the competitor is not able to, gain market share from it, and so on and so forth. So that is the reason why these great investors, they all go for companies which have moat around it. So to put it from an Indian perspective, let's say Asian Paints. Now Asian Paints is a company basically which was incorporated way back in 1942, and now I think that company has majority of the market share in case of retail and decorative segment of the paint industry. So those companies are there who have been there for the, so for example, like Colgate has a fair amount of market share as well as mind share. DMart is there because of its low cost operations. So all these companies which have a moat around them are something which is, which is going to create or compound the shareholders wealth over a long period of time. So I'll be making a separate video, as I mentioned, I'll be making a separate video on this particular topic, because this topic is in itself is in very deep, like what exactly a moat is, and how moats help company create or enhance shareholders value over a long period of time, what are the different sources of moats, and so on and so forth. So I'll be making a separate video on this as well. Coming to so second point of what to buy is, like, once we get hold of the once we get hold of the business, it is also very important that one should also do a qualitative assessment of the management. So when I say management, the people or the promoters or the executives who are running who are running that particular company. So one should prefer to invest in companies where the management is candid, where the management is rational about the capital allocation, because we have seen that over a period of time, it is only the capital allocation which creates or destroys shareholders' value. So one has to be very much prudent about how the excess free cash flow that the business is generating is getting deployed. It is not just about generating excess free cash flow. But then the important part is that how you are deploying, or how a management is deploying that excess free cash flow to again enhance shareholders' value over a long period of time. And the second point is that if also see if the company is being driven by owner operators or by agent operators. So there's a very good concept which has been shared by Christopher Mayer in his book called 100 to 1 Multipaggers, wherein he has told that there are companies, so basically companies are driven either by owner operators or agent operators. So when I say owner operators, so companies like Amazon, where the or Berkshire, where the owners, or in case of Amazon, let's say Jeff Bezos is the who is the founder and CEO of this of the Amazon, is basically, so basically the company is being driven by the owner or the promoter himself. So since it is being driven by the owner himself, so obviously that feeling of ownership will and come into picture. Whereas if you take company which is where the CEO is doesn't have any stake in in the stock of that particular company, then usually that particular CEO or a particular management will be only interested in getting salaries, and also they may not, so their decisions based on capital allocation may not be in sync with enhancing shareholders value uh, perspective. So that is why it is important that we should also see if the management has a sufficient stake in that particular company or not. So that was all about what to buy. Third point is when to buy. So again, even if you have narrowed it down to a great company, because we usually see that these great companies, they always trade at a premium in stock market. It is not that, and hardly you will you in very few, rarely you will find these companies which which are you will get it at a very throwaway prices or cheap prices. But then again, it is important that we should try to understand its intrinsic value, and then buy it at a discount, sufficient discount to its intrinsic value. Because even if you have got a good company which ticks all the pointers of your company, which is having a moat, and if that particular company has a good that particular company's management had a good stake, even if that company even that company can turn it to be a disaster if it is bought at overpriced levels. So that is why it is very important that the valuation comes into picture, that one should only buy it at a substantial discount to its fair value or intrinsic value. So we can deploy margin of safety principle, and I think I've discussed a lot about this particular topic, so you can definitely go out and check my videos of how do we calculate a fair value or the intrinsic value of a particular company or a particular stock by using DCF or a discounted cash flow method. So that was about, so point one, two, and three were basically like what to buy, which wherein we have covered pointers one and two, and second one was when to buy, which is basically your buy at a substantial discount to intrinsic value. Now, very key fourth pointer or the fourth circle I would say here is that how much to buy, because all these factors like a good company with good management and companies with the wide economic modes trading at substantial discount to its intrinsic value, all these factors don't confluence together very regularly, because rarely you will get such sort of events that could be during at a time of recession or the or as last year we have seen that in somewhere in the month of March when when the index is corrected around 20-25%. So it is only during those times that you will get these good companies with moat and all trading at a discount. So it becomes imperative that one should take advantage of it, and for that there is a very a good concept of Kelly's formula, which again I'll be making a separate video for it. But then it is basically used for how much of your bankroll. So let's say if you have 100 rupees in your bankroll, how much of that 100 rupees should you bet on that particular stock? So again, the formula basically talks about what is the probability of you winning. So when I say winning, it is like what is the probability of you being correct, and if you are correct, then how much you are going to gain. So let's say if I'm tossing a coin and let's say if it comes at as heads, and if I have bet 1 rupee, so I'll triple my money. So basically for one rupee I'll get 3 rupees. So basically so that is the maximum that I can win. And what is the probability of heads for every coin toss is basically 50-50%. So it considers those factors into picture, and then it tells so this particular formula tells that how much of your bankroll or how much of your capital that you have right now you should invest in that particular stock. And I think one should definitely read Monish Pabrai's book called Dhando Investor, wherein he has mentioned stressed a lot about this particular concept. So I would definitely urge all the investors out there to read this particular book. It is absolutely a great book. So that was about the Kelly's formula, that how much to bet, right? So we have covered what to buy, when to buy, how much to buy. But then very important point that most of us we forget is that even if we have got good companies at good prices and we have put a substantial amount of capital to that stock, but then even that stock can turn out to be disastrous if we do not sell it at a particular time, or or a time wherein the stock has lost its USP, or stock has lost its moat and all. So basically again it says that one should sell a stock, so we should continuously assess the intrinsic value of that stock. And if that particular stock we are seeing that it has lost its charm, it has lost its USP, so basically then it is high time that we should get rid of that stock. So what this last point says is that one has to sell when either of the two conditions prevail, when the valuations are absurd and are not supported by fundamentals, because we know that growth companies usually trade at a very astronomical PEs and all. And we have seen in the last video that how the price appreciation takes place for a particular company. But then if that high valuations or the astronomical valuations are not supported by the business fundamentals, and if we see that now that the growth rate is going to get flattened and all, it is important, and still see that the stock is trading at a particular at a very high level, or as I mentioned, astronomical P's and all, then one should definitely get rid of that stock. Or if we see that there is a permanent dent in the intrinsic value and now that value is getting eroded, now it can happen due to multiple ways, that there is a permanent damage in that particular industry that has been done, or the management has changed, and the new management that has now been onboarded is not as competitive or as competent as the previous management, and you see that over a period of time the intrinsic value of that particular stock might start declining. So in these two cases, and there are some other cases as well, but then broadly these are the two cases wherein one should definitely get rid of the stock and profit from that particular transaction. So that was all about investing in particular, wherein I have tried to capture pointers like what to buy, when to buy, how much to buy, and when to sell. And that is broadly investing in stock market is all about. So guys, if you have any doubt on this particular topic, or if you want me to make a separate video on some topic that you require, then just let me know in the comment section, and I'll be very happy to help you out. So that's all for today, folks. Thank you and have a nice day.